Let's go ahead and get started. Once again, good afternoon and welcome to today's webinar. My name is Peter Benjamin. Today's session is going to be awesome. We have a longtime friend of ACUMA joining us today who will impart a great amount of compliance wisdom on all of us. Before we dive in, just a few housekeeping items. Let me make sure I'm looking at my list correctly. Just like the past lightning rounds, this session will be recorded and will be posted to our website at a later date. Also, I will be monitoring the chat. Feel free to ask questions and I'll do my best to weave them into the conversation. And finally, thinking of 2023 and as we look ahead and really start planning out next year, we have a lot of great things happening here at ACUMA. We're excited to share them with you. If you didn't receive the email, you may, or perhaps you did, you may notice that we opened up registration for our 2023 workshops being held in Dallas and Louisville, Kentucky. If you haven't already registered, please do so. These are going to be awesome events, and we look forward to seeing you at one of them. I think that's it for today. Yep, that's it. All right, so today's ACUMA webinar is being brought to you by our friends over at Black Knight. Joining us today is Sean Dugan, Managing Director of Origination Technology Sales. Sean, welcome, my friend. How are you today?
Thank you, Peter. It's my pleasure to be here. Really excited to sponsor this valuable session today, and looking forward to getting started.
Well, Sean, I like starting off by saying, in addition to sponsoring today's session, to which we're grateful, we are grateful. Black Knight is a long supporter of ACUMA. Our members and really the credit union movement. I am. It's my pleasure to really thank you for being here. So coming back to today's topic, a journey into how past regulatory changes has potential to influence how our industry approaches compliance and really internal controls. Having a good understanding of all the great things that Black Knight is doing, and really your focus on compliance, Sean, do me a favor. I want you to walk us through a few things. Okay, sound good?
Sure, sounds good, Perfect. Peter.
All right, so Black Knight and your Empower LOS has experienced significant success within the credit union industry. Walk us through why you're experiencing such great success.
Sure. Yeah, it's a good question. I think the LOS vendor landscape, if you will, across all channels or verticals is really fragmented. You got a variety of providers with a variety of services, and I think especially in the credit union vertical, you've got some vendors that have exited the space. You've got potentially some others that aren't maybe investing as heavily as they have previously. And we're the opposite, right? We have been making substantial investments in our technology for the past decade, and even before then. Most people are aware we've been on a pretty significant acquisition spree over the last 3 or 4 years to kind of build out our ecosystem. And really over the last 3 years, due to our relationship with ACUMA very much, and we really do appreciate that relationship, we've become uber focused on the credit union vertical as a whole. And, I think the capabilities that ecosystem delivers and the white glove implementation effort that we deliver, that has started to get, a reputation, if you will, or word of mouth has started to spread. And we all know that credit unions share information very freely. So, 3 or 4 years ago, I think our credit union penetration was probably pretty low. As of today, if you look at the entire Empower install base, approximately a third of our clients are credit union clients, with the other parts comprised of a third being financial institutions and the other third independent mortgage bankers. So we're very focused on this vertical, and we love collaborating with our credit union clients.
Oh, that's awesome. It's one thing that we learned, along the way, just, as we go through our careers, is that really culture is everything, right? And coming back, really focusing on today's topic, compliance is really built into Black Knight's culture, right? That plays a significant part in the decisions that you make, and really empowers track record of helping their clients manage the ever-changing mortgage compliance. So walk me through, how that culture's been, the compliance culture's been interweaved into really Black Knight and Empower.
Yeah, it's a cornerstone of our entire company. We've been around now for 35 years, and many of you know that where we really kind
Sean, I think I
of
lost
where
you.
we really kind of cut our. Sorry, I might have some internet difficulties on my side. You just let me know, Peter, if you can't hear me. 19, we support 19 of the top 20 volume lenders in the country, and the rigors from a compliance perspective that those institutions demand are something that we've lived with and supported for the last 25 years. As a matter of fact, we're regulated. We're of the size and scope that we're regulated ourselves by the FFIEC. So, part of it is that culture. I think the other part of it is really delivery, and we've just got I would say, an exemplary track record of not only delivering, enhancements to our software to allow our clients to manage compliance. I'll give you one example. Everybody remembers TRID. It's a very warm, fond memory, I think, for most everybody here. So the deadline for TRID was to comply by October of 2015. We delivered to our clients in December of 2014. We delivered and provided 10 months of time for testing, for interpretation, and it's that proactive capability that Black Knight has built that culture that of compliance that you mentioned previously.
That's warm fond memories of TRID. All joking aside, I actually do have warm fond memories of TRID. I actually proposed to my wife on TRID implementation day. Call me a romantic, but that's I wanted to remember the day. Anyways, I'll come back. Again, truly warm fond memories, right?
That is tremendous.
But you mentioned something. You've been on an acquisition spree. Creating the sound and this diverse ecosystem within that one environment, right? For within Empower, how is this an advantage to credit union members from, cost, efficiency and vendor management perspective? I mean, you and I both know, there's a lot of components to lending, in the tools that we need to be successful. So how is this really an advantage, having everything in that one ecosystem?
Sure. I think there's one thing to keep in mind. This whole bundle philosophy, or an LOS coming to the table with additional components as part of their offering, that's not new, right? Other people have done that. I think what's different about our approach is we've gone out and made acquisitions that are absolutely best in breed. So you're not making sacrifices on your pricing engine because we deliver Optimal Blue, or your CRM because we deliver Surefire. And our bundle is really expansive. It'll include, in addition to the CRM and Optimal Blue, reporting, artificial intelligence, machine learning, a decision engine, fees engine from Ernst, e-signature, e-close, property tax, and a compliance engine. And so a really best in breed, expansive bundle that will actually deliver a takeout capability where a lot of the lenders that we onboard no longer need 3, 4, 5 third-party contracts with vendors that normally would deliver these services. So there's savings there. Obviously, now we deliver this under one transaction fee and one contract. So from a vendor management perspective, you're only dealing with one entity. So there's savings there. And then given the automation, a task-based workflow, the efficiencies that the Empower system delivers, we see really significant savings from what I call a time and motion perspective. So the amount of time that your employees need to spend manually with a loan file greatly decrease. We see the cost to originate reduced and cycle times reduced as well. And then lastly, again, all those integration pieces that a lot of times a credit union would need to manage themselves, we handle that entirely. So those are some examples of the cost savings and the efficiencies that the Empower ecosystem would deliver to a credit union.
That's awesome. That's awesome. Well, Sean, that's all the time we have for today.
Thank you so much. You guys
I
enjoy. Happy holidays to everybody.
Thank you very much. I appreciate your time today. Thank you very much for sponsoring today's event.
You got it.
As I mentioned, today's session focuses on how past regulatory changes had the potential to influence how our industry approaches compliance. Today's speaker is a bona fide expert in all things compliance. It's my pleasure to welcome Michael Christians, Regulatory Compliance Counsel with Michael Christians Consulting, LLC. Michael, welcome.
Peter, good to be with you. Thanks for the opportunity, and good to be with all my friends at ACUMA.
I love it. I love it. All right. Well, Michael, there's a lot to talk about. Well, that's just putting it lightly.
Yeah.
You know, especially as we think about the past year and start the process of looking ahead to 2023. So you and I sat down last week and put together a rather long list of items that we thought was important to talk about. You know, and rather than going through a series of questions, let's just approach this from a list format. We'll just go down the list and hit some items pretty good. Sound good?
I think that sounds great.
Awesome. All right. So first up, we can't start this webinar without summarizing 2022.
Yeah.
Do me a favor. In your words, let's do that 2022 year in review.
I think that's a great place to start. Let's first take a look at the CFPB's supervisory highlights. This is a document that the Bureau puts out twice a year. And what it does is it goes back and it looks at common examination findings that occurred throughout the year.
Mm-hmm.
Now, of course, it looks at the entire scope of a credit union's operations, but focusing in specifically, what are some key elements we can pull from that from a real estate perspective? A couple things here, Peter. Number one, LO comp. You know as well as I do, we could do an entire lightning round on LO comp, right?
Oh, and we have, I think.
Sure. There's a couple things that I want to point out from an LO comp perspective. Number one, be very careful about varying your compensation based on loan product type. There's some information in the CFPB Small Entity Compliance Guide that says that more often than not, varying compensation by product type is going to run afoul of the rule, because when you think about a product, it's really a bundle of different terms, right? And we know that that's the whole point of the LO comp rule, is to avoid compensation based on terms of a transaction. The other thing I want to talk about from an LO comp perspective is, because this one especially in my mind is really kind of backwards. Because if we think about LO comp, what we're trying to do is make sure that we're not incentivizing LOs to put a borrower into a more costly program. And so we think about reductions in an LO's compensation. When is that permissible? And you would think if an LO is voluntarily agreeing to reduce his or her comp, that's going to be fine, right? Well, not necessarily. The rule really only identifies one area where an LO can voluntarily reduce his or her compensation, and that's to offset an unforeseen increase in settlement costs. So you need to be very careful about those reductions in LO comp as well.
Mm-hmm.
Those were just a couple things that the CFPB found that institutions were struggling with from an LO comp perspective. The other thing I want to point out from the supervisory highlights, going back to your favorite compliance holiday, obviously TRID, which I didn't know that prior to today, but I'm sure your wife is very happy to celebrate that with you on a regular basis. Yeah,
She is. Yeah. Call me a romantic, Michael.
right. Yeah. Let's talk about changed circumstances, okay? Because when I'm talking to my clients, this comes up all the time, and so I was not surprised at all to see this as part of the supervisory highlights. We've got to do a really good job of documenting what a changed circumstance is and when, in fact, it occurred, right? Because here's the rub. So many times I have a credit union tell me, well, we documented when the changed circumstance occurred because we put a copy of the revised LE in the file. Well, that doesn't do it, right? Because remember, the rule requires that the revised LE be provided within 3 days of the occurrence of the changed circumstance. So the date of disclosure really is irrelevant for our purposes. We need to look at when that actual changed circumstance occurred. So just be very careful from a documentation perspective.
Right. So it's the known change, right? I think that's the most important thing, right?
Absolutely.
And even if it's not changed in the system,
Yeah,
it's when we discover it.
Right. Because I, as the loan officer, can have a conversation with the borrower on Monday. And Monday is when the borrower says, I want to change product type. That's when the change circumstance occurred, not Thursday or Friday or the following week when I finally get around to sending out the revised LE, right?
Right. So let's go back to LO comp if we can, and varying by product type.
Yep.
Okay. Is it okay to say pay differently if it's a first mortgage versus a HELOC? Is that permissible? Is that allowed? First mortgage versus second mortgage?
Yes, I would say that would be permissible because again, we're worried about bundles of terms, right? But we're worried about anti-steering as well. And so I think obviously just looking at the perspective of it's much more involved to do a first mortgage than it is for, say, a HELOC, right?
Mm-hmm.
So I think naturally you're going to have varying compensation based on those product types. I think where we need to be a little more careful, Peter, is looking at, maybe secondary market loans versus portfolio loans or something like that, right? And that's not to say that there's not a way that you can structure it. You just need to pause a minute, take a step back, and make sure that you're thinking through appropriately how to structure it.
Okay. I got that. Okay. Thank you very much for that. All right. So let's come back to 2022 year in review.
Yeah.
And fair lending was a big topic. Walk us through that.
Yeah. I mean, it always is, right? Fair lending is always kind of top of mind. Some common fair lending hiccups, I guess we'll call them. And I don't know, I read some of these and I know that, this group, the ACUMA group, this is stuff that you guys probably don't struggle with, but, we learn from others' mistakes, right? So
Mm-hmm.
it's good to look back from a fair lending perspective and see where you can get into trouble. So first one, remember, as far as requiring a spouse's signature or somebody else's signature, okay, from a real estate standpoint, sure, we can do that on a mortgage, a deed of trust, etc. But what we need to be careful of is if I come to the table as a borrower and I qualify individually, aside from those security instruments, there's no real reason or basis for us to be requesting the signature of another person. The other thing we also have to be careful of, if I don't individually qualify, and we're going to need a co-signer, That's fine. The credit union can ask for a cosigner, but you got to be careful of not implying or demanding that it's got to be my spouse, right? It's up to me as the applicant to present to you as the creditor who I want to be considered in that cosigner capacity. Remember, as far as those sources of income like alimony, child support, separate maintenance, remember, if I'm not relying on those as a basis for repayment, you really shouldn't be asking about them, right? And if you think about it, from an underwriting perspective, if I come to the table and I'm able to qualify based on my W-2 wages alone, why are you still asking questions, right? This one I love. I've been doing compliance for, 20 years now, and I cannot fathom how this would ever come up in a loan interview. But Reg B says we can't ask about an applicant's future childbearing intentions. Well, of course not. I mean, what does that question look like? How many kids are you going to put in this house you're going to buy? I mean, it's ridiculous. But know that while that question is off limits, there are certain things from a dependent perspective that we can consider, right? How many dependents does the applicant have? Ages of those dependents, expenses of those dependents, because those all go to disposable income. But as far as future childbearing intentions, just doesn't make any sense. Last thing I'll say from a fair lending perspective, Peter, under Reg B, we have that rule about for a loan secured by a first lien on a dwelling, we have to provide within 3 days of application a notice of right to receive copy of an appraisal. And then we've got to provide that valuation promptly upon completion, not later than 3 business days before closing. Couple issues here that I see happen somewhat frequently. Number one, remember, I hear credit unions tell me all the time, I only have to provide that in connection with a purchase. Well, that's wrong, because it's based on lien position, not on the loan purpose, right? And then number two, remember, even though it talks about notice of right to receive copy of an appraisal, the rule is bigger than that. It really covers any type of valuation except for tax assessed value. So if you're basing your decision off of broker price opinion, automated valuation model, you got to give them a copy, and it's got to be at least 3 days before closing.
Okay, so this fair lending topic really brought up several questions.
Okay.
Coming back to your second point about alimony, child support, separate maintenance payments, right? This is really almost like loan officer 101 type conversations, right? You almost train a loan officer to ask to ask their borrowers, hey, do you receive alimony? Do you receive child support? Any type of other separate maintenance, right? But it's the loan officer's job to ensure the borrower can qualify without, right? So it's up to the borrower to really determine whether or not they're used that to qualify, correct? And then the underwriter essentially validates if they can qualify without. Now, would it be a best practice? I mean, this is tough, right? Because where you train a loan officer to ask the question, right? Do you receive this, and do you want to use this income to qualify? You almost have to ask the borrower that question. It's almost based off of fair lending, and the scrutiny fair lending is getting as of late. It's almost not even asked that question until after the fact. That seems like the path of least resistance to keep you safe from compliance issues, but you run into underwriting issues.
Yeah, I think from a best practice perspective, let's reword the question, okay? Let's not ask, do you receive alimony, child support, or separate maintenance? Let's ask, is there any other income that you would like us to consider for purposes of making a decision in connection with your application.
Okay. I like that. Okay, good. Okay. Moving on to the next question I have. All right. So
Okay.
obviously we can't ask about childbearing, right? We can't ask, do you plan to have kids?
Right.
But we obviously we can ask about the dependents. And so in your mind, what is because there are some loan types that take that into consideration, the number of dependents in qualifying. There are just some loan types that require that.
Yep.
All right. So it's similar to what I guess the last question was. What's the right way to ask that question?
That's tough, right? I think going back to your point, I think if the applicant is looking at a loan program that specifically takes those things into consideration, then that becomes maybe an appropriate question as part of your loan interview. I don't see this exception used that often under Reg B. And here's what I mean by that. The reg tells us that we can consider the number of dependents and the expenses associated with those dependents. In my mind, I think about that from an underwriting perspective. Those expenses get lumped in to all of those other things that we generally don't consider as part of our debt analysis, right?
Mm-hmm.
Like, for example, you don't ask a borrower how much they pay for their cell phone bill.
Nope.
You don't ask a borrower how much they pay for their internet access or their water bill or their electric bill or whatever the case may be. So I just don't see those questions really making a significant presence in the loan interview about a dependent's expenses.
Okay. Good deal.
Yep.
That's fair. Okay. Excellent. So is there just making sure that we hit 2022 and close the books on 2022?
Yeah.
Anything else that you want to bring up about 2022?
I think the other thing that we probably need to kind of, and maybe this is a good transition for us, because this really did kind of finally come to fruition in 2022. But if you don't mind, let's spend some time talking about the QM changes. I think that's a big thing.
I don't mind, because this hasn't just been 2022. This was
Right.
really what, 2020,
Yeah.
2021, right?
Yep.
Was it Craniger came out with them verbally agreeing to change the QM rule, right? And it's kind of just been a waiting game ever since. And here we are, 2022, possibly getting some changes. Let's hit that up. I think that's so. Really, the question is back to you, if you don't mind, Michael.
Yeah.
But let's spend some time on QM.
Yeah, no, I think that's good. And to your point, Peter, I think why we need to spend some time on this is because it does go back a little ways, right? Because if you remember, we had this kind of back and forth from the CFPB because all of this occurred during the transition from one presidential administration to another, right? And so because of these delayed effective dates, we found ourselves in a situation where this revised QM definition was applicable for secondary market loans back in 2021 or 2020. It just now kind of went back out across the board, and October of this year was now applicable to portfolio loans. So it was a little bit of a jumbled implementation. Imagine that, right? So let's talk about it. Revised QM. First, let's go down memory lane about what a QM used to be, okay? Maximum debt to income ratio of 43%. That was number one. Number two, regular periodic payments, term not to exceed 30 years. Number three was a points and fees cap
Mhm.
And number 4 was we underwrite the loan in accordance with Appendix Q. Okay, that's where we were.
The infamous Appendix Q.
The infamous Appendix Q. You got that right. So where are we now? Well, let's get rid of the easy ones first. Okay, we still have a 4-part test, but let's get rid of the easy ones first. No changes with regards to product requirements. Okay,
Mhm.
still have to have regular amortizing, and loan term does not exceed 30 years. We also still have points and fees caps. Okay, so that leaves us to the first big change that we had was we replaced the DTI test or the DTI cap with a pricing test. And what we're doing is we're looking at the APR charged in connection with the loan and comparing that to the average prime offer rate index. And so long as that spread between the two does not exceed a certain threshold, depending on loan amount and lien position, then we've satisfied the pricing test. Let's talk about the pricing test for just a minute longer. Do I agree that the 43% DTI should have gone away? I do, because that was just kind of an arbitrary number, right?
Mhm. Yep.
Do I think that we should have replaced it with the pricing test? Not necessarily. I think it goes to a core consumer protection to make sure that we're not having borrowers pay exorbitant interest rates, but it doesn't really speak to ability to repay in my mind.
Doesn't.
But you know as well, you've been doing this long enough, Peter, to know that if you try and spend time figuring out the why on some of these compliance things, you're going to drive yourself crazy, right?
Well,
So anyways,
that's why we have you, Michael.
yeah, exactly. So it is what it is. Now, one other thing about the pricing test. Those of you that are small creditors, okay, remember as a small creditor, and what that means is you do less than 2,000 covered transactions,
Mhm.
and you got assets of less than 2.336 billion, I think is the number. You were exempt as a small creditor from the 43% max DTI. As a result, you are also exempt as a small creditor from the pricing test. So that's good news. So that takes us now to item number 4, which is that, as you indicated, the infamous Appendix Q. Now, this is interesting. This is a question of be careful what you wish for, because I heard credit unions complain all the time about Appendix Q. It's too strict. I want to underwrite loans my own way. Okay. That's what the revised definition gave you.
Mhm.
Appendix Q is gone. Essentially now under the underwriting test, you come up with your own underwriting guidelines. But once that safety net was kind of out of the picture, lenders were like, well, I don't want to write my own underwriting guidelines because I don't want them subject to scrutiny. So what the CFPB has done is said, okay, you've got latitude to do this, but we're going to give you a safe harbor. If you underwrite your loans in accordance with secondary market guidelines, Fannie, Freddie, HUD, whomever, you have a safe harbor for compliance. And I think that's what most institutions are doing, is they're underwriting to secondary market standards. So they don't have to come up with their own underwriting guidelines, which of course are going to be subject to a higher level of scrutiny than what the safe harbor is.
Yep.
So QM, revised definition, is now applicable across the board, secondary market and portfolio loans. So here we are.
Okay. There's one other component though, right?
Yeah.
There's that new season QM, right?
Absolutely.
Let's
This
walk
thing
through
is,
that.
yeah, this thing is a gem. So, and the reason that I say that is because It's something that we don't really have to think about for 3 years. And let me explain why that is. So what you're talking about, Peter, is the new category of qualified mortgages, the seasoned QM.
Mm-hmm.
Now, it's available in connection with transactions for which the credit union received an application on or after March 1st of this year. But when I say you don't have to think about it for 3 years, let me explain why that is. In order for a loan to be eligible for seasoned QM status, we've got some product limitations. It's got to be secured by a first lien. It's got to have a fixed interest rate. There's a points and fees cap, etc. We have those same underwriting requirements where we can underwrite according to our own standards, or we can choose to underwrite according to secondary market standards. But here's where it gets interesting. A seasoned QM must meet both portfolio requirements and performance requirements. And what that means is that at the time of consummation, in order to be a seasoned QM, that loan cannot be subject to a forward commitment, and it's got to be retained by the credit union for the duration of what's known as a seasoning period. Now, that seasoning period is 36 months from the day upon which the loan's first periodic payment is due. So you see where I'm going with this, because that seasoning period, the earliest it could have started is what? April, May of 2022. Nothing's going to really achieve seasoned QM status until the middle of 2025. And by the way, during that seasoning period, the performance requirements is less than 2 delinquencies of 30 days or more, and no delinquencies of 60 days or more. So know that it's out there. It will be available, but nothing we really need to pay attention to at this point in time.
But it's interesting, right? Because we often forget that the things that we do today impact people tomorrow, right?
Sure.
So the underwriting practices that we go through during the origination process have potential to impact servicing in many ways, shapes, or form. I mean, that although this is a seasoned QM or seasoned QM loan, it's still, we still have to make sure that that borrower that we've documented the ability to repay, not just for those 3 years, right? That 3-year kind of gives us safe harbor after the fact, but it's really that 30-year process, right?
Well, and I think, I mean, what you're speaking to, Peter, is the primary consideration of the entire ability to repay rule, right? Because if you think about it, you don't have to make a loan as a QM to satisfy the ability to repay rule.
Right.
But to your point, the long-term benefits to doing so are the reasons why we go the QM route versus the 8 ability to repay factors, right? Because we have that presumption of compliance, which protects us on a go-forward basis.
Right.
Yep.
I'm gonna give a before we move on, I'm gonna give a bad dad joke, if that's okay.
I love it.
I just get all the time. Whenever I used to manage loan officers, manage a mortgage division, something like that, people always ask me, do you have any seasoning requirements? And I always respond back with, we lend in every season. Doesn't matter, fall, spring, winter, summer.
Oh boy.
No seasoning requirements. And people, the number of people that just roll, just like you did, roll your eyes at me. But it's one of my favorite dad jokes, mortgage dad jokes. Anyways, I digress. All right, so
moving on quickly.
Moving on very quickly at a fast clip. We're almost out of time. So we talked about QM. We talked about the EM review. Let's talk about something that just like QM, like TRID, just doesn't seem to go away, and that is our one of my favorite topics, LIBOR. Let's talk about the transition away from the London interbank offered rate.
Yeah, the labor of LIBOR, right?
That's right, seriously.
So you're absolutely right. This is something that has been, how long have we been talking about this, Peter? Years, right?
5 years at least.
Yeah, at least. So let me give a little background. So LIBOR, as Peter indicated, London interbank offered rate, it's an index. Several years ago, US and foreign regulators noticed that LIBOR was not behaving in line with market expectations. So they did an investigation and figured out that the index was being manipulated for profit. As a result, several years ago, the I just blanked on the name of the index manager, but anyways, that organization decided several years ago that the 1 month, 3 month, 6 month, and 1 year LIBOR indices will cease publication in June of next year. Okay. What I'm concerned about is that this is not being given the attention that it deserves. Because it's very easy to say, well, that's June of next year, so I'll worry about it then. But I think what we need to think about is why we need to put this into motion now, because as we're thinking through the transition away from LIBOR, we have a bunch of stuff that we need to do well in advance of that actual cessation date, right? So a few things here that I want you to consider. Knowing that LIBOR is going away, if I've got an adjustable rate product that's tied to LIBOR, I know I'm going to have to replace that index. I've got to decide what my replacement index is going to be. Now, the Alternative Reference Rates Committee, which is a subcommittee of the Federal Reserve, came out and said, we are recommending that the SOFR index, the Secured Overnight Financing Rate, be used as a replacement index. That's a recommendation, not a requirement. If the institution wants to go a different route other than SOFR, you can, but there are some very specific things that you're going to need to consider as you make that determination. What you want to do is you want to look and compare LIBOR with your new selected index, make sure that the movement of the indices has been comparable over time. Make sure that that replacement index is going to have a comparable impact on the borrower's payment. Make sure that that replacement index is publicly available and something that is outside the control of the credit union, okay? Now, some of these advanced requirements, so for adjustable rate mortgage loans, the reason we got to start thinking about this now is that we need to notify a borrower in advance of when their index is going to change, right?
Yep.
And so that's why we can't wait until June of next year. In addition, we're going to have to make some changes for new arms that we do after we've selected the replacement index. We're going to have to make some documentation changes. In our application documents, we've got to identify the new index, a source of information about the index. We've got to be using a revised version of the CHARM booklet or the Consumer Handbook on Adjustable Rate Mortgages. And the other thing I want you to be very careful about with LIBOR, and I maybe should have focused in more on this when I was talking about that replacement index. It's really important that you select an index that is going to pass that comparable test, because when you are replacing the index in connection with an arm, if you select an index that is not comparable, replacement of the index is considered a refinance for purposes of Reg Z. And we know what that means. A refinance triggers what? New disclosures, a new ability to repay analysis, etc. So again, we talked a little bit about these safe harbors when we talked about QM. I don't know, this is just me. There's some value to go on the SOFR index route because it's already been identified as comparable. So we steer clear of those potential refinance implications.
Okay. SOFR, it's the one most certainly that's being pushed, right, as the acceptable replacement for LIBOR. But I mean, there are some concerns, right? It still is a new index. We haven't seen how it performs over time, how that would impact our portfolios. It's also 1 month versus a potential 1 year. That's a concern. At the same exact time, although it's being pushed, the SOFR, the CMT, or the constant maturity treasury is still very much a viable option, right?
You bet.
I think
Absolutely.
I think the one index that the CFPB has said not to use is prime, right? That's literally the one that they've come out and said, do not use prime. Like that is a no-no. Like that is not a comparable index. But the rest, CMT, it's been around for a while. It's most certainly one of the indexes that the GSEs are using for their arms.
Yep.
So we know that that's an acceptable one. But again, there's still some concerns about SOFR. So as much as I love TRID, the LIBOR is very interesting. The background behind it, and how it's moved forward. I still think there's a lot being left, up to us to figure out along the way. So I still think, in a personal opinion, that we still need more guidance around the transition to LIBOR, but transition away from LIBOR. But if we hadn't started this process, we're probably coming up a little late to the game, right?
Right. Yeah. And I think that's the key. Is I agree with you 200%. We need more guidance. The CFPB needs to be more active in this space because it's been going on so long. We've gotten accustomed to kicking the can down the road.
Yep.
So I agree with you 200% that there should be more guidance, but we can't wait forever for the guidance, right?
Right.
We're at a point now where the rubber needs to meet the road.
Right.
And so just be thinking through, from a timing perspective, some of those decisions that your credit union needs to make.
Okay. We know. So I think this is a good transition to the next point that we want to hit real quick. We know that June next year, LIBOR transition away from the LIBOR. Excuse me. What else do we need to look at for in 2023? Like, give us that we'll say that forward vision and that crystal ball.
Yep. Well, of course, my compliance crystal ball has been cloudy ever since I purchased it. But with that being said, a few things. Remember, in March of next year, we have the additional page being added to the IRLA. That's that supplemental consumer information form. This is going to need to accompany the IRLA for any loan intended for sale to Fannie or Freddie after March 1st of next year. And on this form, or on this additional form that's part of the IRLA, the applicant is able to identify their preferred language and identify whether they have participated in any homeownership counseling. So be prepared for that. We, of course, have to think about all of the revised thresholds that are going to affect our day-to-day operations. A lot of these we don't have yet, but some things to think about. Remember that the points and fees cap for QM is adjusted annually for inflation. And in case you have yet to come out of your COVID bunker, inflation has been kind of a topic. So we're going to see some, in my opinion, pretty significant adjustments in some of these thresholds.
Okay.
So QM, points and fees cap, QM, pricing test, loan amount. There's an adjustment under the higher price mortgage loan threshold, and there's an adjustment under high cost mortgage. So I'm going to guess any day now, we're going to get that rulemaking from the CFPB. So make sure you're keeping an eye out for that. But I think, Peter, I think what we need to think about the most in 2023 is, what does the general regulatory landscape look like, right?
Mhm.
We saw a significant transition. We went from the Kraninger administration at the CFPB, where the CFPB was very hands-off, right? And now we have Director Chopra, who comes to the CFPB from the FTC, been a long time consumer protection advocate, was actually instrumental in the initial creation of the CFPB. So we have seen the CFPB return to principles of things like regulation by enforcement, a significant increase in the pace of its rulemaking. So I guess the point that I'm trying to make here is that while most of you are probably not directly supervised by the CFPB, what you have to understand is all of this stuff trickles down, right?
Mhm.
And so NCUA takes their cue from what CFPB is seeing in the regulatory space. So do your state credit union examiners, et cetera. So good news, bad news here, right? Bad news for you guys from the perspective of the regulatory landscape is certainly not going to get any less intense over the next couple of years. But good news is you're going to see a lot more of me. So
That's good.
Yeah.
Now, it's interesting you brought it up. And listen, we're quickly approaching time.
Yeah.
And this is I think this final thought is really just, I want you to take that cloudy crystal ball and really buff it out a little bit,
Yep.
because over the past really 12 years, really since the establishment of I guess 12, 13 years since the establishment of Dodd-Frank, then the CFPB, then we saw LO comp, we like keep TRID, the revision to HMDA, I mean ATR QM, and we can keep going down this list of things, right?
Yep.
But now you have Chopra, which is interesting, like, because regulation by enforcement, but the guy does a lot of blog posts.
Yes.
More than anyone else. Like he's out there posting a lot.
Yep.
But I come back because here we are spending a lot of time, a lot of energy, a lot of money on changes made by the CFPB. So here's the question. We'll say the late, this was October, right? Mid-October ruling by, was it the Louisiana Circuit Court of the constitutionality of the CFPB?
Yep.
Does that get any traction in 2023?
Yeah, I'll be honest with you. I don't think so. Let me set the stage here just a little bit. So this came out of a case that was a challenge to the 2017 payday lending rule.
Mhm.
And basically the challenge was that the CFPB didn't have authority to make this rule. The district court granted summary judgment in favor of the CFPB. I believe it was the Community Financial Services Association of America, I think, was the petitioner. So they appealed to the circuit court. And a 3-judge panel of the circuit court, part of that appeal to the circuit court, was that, wait a minute, the CFPB is unconstitutional based on its funding because the Constitution requires that appropriations be made by Congress. The CFPB doesn't get their funding from Congress. CFPB gets their funding transfers from the Federal Reserve.
Mhm.
So we're going back to, and this is not the first constitutional challenge to the CFPB that we've seen, right? But the question is, does this get traction in 2023? The case will probably get traction. Do I see the constitutional challenge surviving? Probably not. And even if it does, I don't think the argument that means that everything that the CFPB has done up to this point goes away. I think it simply means that you adjust their funding mechanism to the appropriations process going forward. There's no appetite for the CFPB to completely go away, even for those institutions that absolutely despise the CFPB. Because to your point, Peter, how much time, how much money, how many resources have institutions put into gearing up for compliance with all of these different rules? If all of that stuff goes away, that's all for naught.
Mhm.
And I also don't think, as far as if there are some players who shall remain nameless that in the market continue to do things like give people credit cards they didn't apply for, open accounts that they didn't ask for. As long as those things continue to happen, the necessity of a consumer watchdog is going to be there. So I just don't see us going back to getting rid of what the CFPB has done. I think it's here to stay. It may just look a little bit different going forward.
Okay, well, thank you very much. Well, Michael, we are approaching all the time we have for today. I think it's
Yep.
time to wrap up. Before I say my parting words, any quick final thoughts?
I just, again, thanks for having me. Love working with all of ACUMA's members. I wish all of you a happy holiday season. I look forward to seeing you at the workshops next year in Dallas and in Louisville. So thanks, Peter. Good to see you.
Absolutely, you too. You too. Well, thanks again to Black Knight for sponsoring us, for sponsoring today's session. And to Sean for calling in and walking us through some great and important things that Empower's doing over there. To our ACUMA members that attended today, thank you taking time out of your busy day to spend really the last hour with us. We hope that you found all of this information valuable and insightful, and you're better prepared to tackle next year. Before I part ways with you, don't forget, registration opened up for our 2023 workshops being held in Dallas and Louisville today, but also be on the lookout for a lot of great things we have coming to you next year. With that being said, have a safe and happy holiday season. Thank you very much. Bye-bye.